founder or an entrepreneur. You wanna take your company value to 300 million, we gon' show you how to do it. But we got the roadmap, the aspirations. We'll give you a game plan and strategies. Seize control of your company's destiny today by tuning in to Private Capital Mastery. Let's start the show.
Welcome to Private Capital Mastery, the podcast where we delve into the art and science of being an entrepreneur. I'm your host, Brian Franco, and I'm here to guide you through the complex landscape of private capital, offering insights from advisors who have specialized expertise in the art of private capital. In today's episode, we're diving deep into the intricacies of preparing companies for transactions and helping them navigate through distressing times. It's a roller coaster ride in the world of capital, and being well prepared can make all the difference. Joining us today is a distinguished guest who has not only witnessed, but has had his hand in orchestrating success stories. Mr. George Blanco. George, thank you for being here with us.
Thanks, Brian. Thanks for having me here.
Yeah, it's good to have you here talking about the work that you've done. Why don't you give a little bit of background on your firm, the work that you do, and really how you when you called in and then
Absolutely.
parachuted in, really, right?
Yep.
Yeah.
Yeah, our firm is it's EMA Group, or Enterprise Management Advisors. And what we focus on is we're a financially oriented or operationally oriented financial advisory firm. So most of our clients have operational issues, and so a lot of what we focused on is how do we help fix the business, document it, and then prepare it frequently for a transaction, either for a refinancing, restructuring of debt, or even a sale process. My background is I was a partner at Coopers & Lybrand, for PricewaterhouseCoopers subsequently, on the consulting side, and then subsequently regional consulting partner for BDO. So I've been involved from very large companies, Fortune 500 companies, everything from Haagen-Dazs to Georgia Beverly Hills to a lot of brand names over the years. And then at BDO was really more of a middle market firm. But the intent of what we're trying to do with EMA Group is really it's companies of various sizes, but it's really taken a more active role with companies. When you're with big firms, you're really limited on what you're able to do. And for us, when we get involved with the companies, we're really working shoulder to shoulder with management. Our team is comprised of guys that have 30 plus years experience. So I've known a lot of these folks for a very long time, some that I've worked with over the years. And it ranges from people with CFO backgrounds with very good quality credentials to people that have been involved in transaction. I have a former partner of a mezzanine fund, so he really knows how to get deals done. And one of our guys, I've worked with him for the last 20 years, and he has a manufacturing background. So we implement lean when we can. So it's really taking a comprehensive look at businesses and what it really takes to drive value.
Yeah, and we've had the opportunity to work with one another on a project, and I've seen your work firsthand, and the level of detail that you're able to bring to founders and entrepreneurs is important, because in some instances and cases, these entrepreneurs, they are familiar with their business, they know how to make the measurements inside their business, and they know how to to communicate that internally from a standpoint of improvement, or are we on track, are we off track. But as you and I both know, an underwriting process when it comes to lending, or due diligence process when it comes to outside investors, they're making different measurements than what a typical founder or CEO are making in their own business. What are some of the examples in real life case studies that you've dealt with where you were parachuted into a company that needed to either be, you mentioned they're sometimes distressed, or sometimes there's a turnaround, or sometimes they're positioning themselves for a sale. You have an approach to how you do that, and what does that look like?
Yeah, and the key point you highlighted is the detail, getting into the detail, because that's the only magic sauce, secret sauce that we have is doing that. And what happens is it ranges. For a lot of companies is that, and for banks, and the underwriting standards are changing for a lot of the lenders, is that you have an annual audit, and they would rely on that annual audit, and that was all they were looking for, right? And so when these loans got booked frequently, the companies were growing, they're very profitable and so on. Now, when something happens and they have profitability issues and they're potentially breaching a covenant, now there's a lot more kind of digging into the detail, right? It's no longer the business development guy who's managing the relationship. It's now the portfolio guy or the credit guy who now wants to dig deep into what happened to the business, why is profitability off, directionally, where is it going, is there a risk of breaching covenants, and then how's it going to get fixed? And I've seen a broad range of things over the years, and everything from crazy to the sublime. And on the sublime end, and starting with that, is going into a company where there's an entrepreneur and he had his act together. And I was really surprised and impressed. And then I dug into the detail with him, and I said, what? So how did you get here to have all the detail I was looking for, so it made the diligence easy? And he said, well, I've been through the transaction process 3 times, and I couldn't close.
Wow.
And so, he kind of got religion, so to speak, and realized, here's all the things I needed to have, the detailed payroll information, organization charts, support for how I drive profitability, how I manage the business, all these sorts of, documentation.
Right.
And it just really hit me at that point that it's not always that easy to get a deal done. Yeah. And if you have a good advisor and they guide you and you follow their advice and do what you're supposed to do, it makes the transaction a lot easier. Yeah. But I think part of the craziness that I've seen, and this is kind of a dual example, is the company was profitable, but wasn't nearly as profitable as it could have been. Mm-hmm. And it was in the logistics industry. And it was doing about $100 million a year in revenue. And it had gone through already a couple of deals that had broken down for various reasons, right? And it wasn't clear why, but as I dug into the detail and started doing the diligence, I started finding stuff like, and it was 2 guys that owned the business and had grown it, right? But they were buying jewelry. They had, there were limos on there, and there was a lot of stuff that I was questioning, what does that have to do with the core business, right? And so when I started taking this out, I said, well, the profitability is going to be better, and it really will match. If we make these kinds of adjustments, it'll match better to what you think it should be from a profit standpoint, right? But we're going to have to clean up the financial records. A lot of the stuff was recorded improperly into the wrong buckets, that sort of thing. And these things that were purchased as gifts, they can't be written off as part of the business. So you can have a tax impact on some of these things, right? So a lot of cleanup needed to be done. We brought in a third party so we could actually do the diligence. And that's kind of a regular thing that happens, that when we get involved, as soon as we see the initial set of issues, whether it's a transaction or if it's even from a restructuring standpoint, is that the books and records frequently aren't up to the level they need to be in terms of the detail. Yeah. And in this situation, we brought in a third party. They helped clean up the books. And the valuation perhaps wasn't as good as they wanted. Okay. But by being able to build the bridge and explain what was causing kind of where they were from a profitability standpoint, from where the industry is and where they could be, we were able to kind of lay out those layers, right? And so as part of the transaction and the deal process, the investment banker and the private equity firm were able to say, okay, look, we see where this is going with, you've done this with George and put together this pro forma. We can only kind of evaluate it at a certain level. But if you want to stay in the deal, and partner with us, then you'll get another bite at the apple. Correct. So as you demonstrate the ability to basically get to that profitability level, right? Yeah. So it really made a big difference. But when you're dealing with a lot of privately held companies, and they really hadn't thought too much about what they needed to do to get to a transaction, it's amazing what people run through businesses. Right? It is.
From a discretionary expense standpoint. And to the point that you were making earlier, you're going in, you're identifying those discretionary expenses. At times they're, that we call them, owner perks and benefits, right? Mm-hmm. And of course, their goal and target is to minimize their tax liability, and you do that by creating expenses within the company. Yep. But when it comes time to valuation, it's our time to seek those sorts of discretionary expenses. Right. Can we classify them as one-time expenses? Can we classify them as a personal perk and or benefit? Mm-hmm. And it's counterintuitive for an entrepreneur because they look at that and they say, well, George, you're going to reclassify these expenses. It's going to be a 20 to 35% tax hit, right? And they just can't get over that sometimes. But when you start to help them understand, well, listen, that tax hit is 20 to 35%, let's say, hypothetically, but if it's a 400% return or 500% return in the form of a multiple on EBITDA, the ROI is there. You just have to show them, because otherwise, the thinking is just to, minimize the tax.
Well, that's what you just explained is one of the magical things I think for people to understand when they're selling their business is that those adjustments in terms of profitability and there's a multiplier effect, right? So if you're willing to make the changes, and that's often what I have in a turnaround situation with family-held businesses. Okay. they've really never looked at valuation and how to affect valuation in their business, right? They know that they've got some people on payroll that are marginally, productive.
Correct.
We've
seen that.
Yeah, and they didn't push maybe the edge on, operational efficiencies because, they didn't have to, right? They made enough money, it was sufficient. But as we go through this process, if they're willing to make these changes, and you pick up that EBITDA value, now it's a multiple, anywhere from 4.5 to 10
Correct,
times,
10
right,
times,
depending on the business, right?
Yeah.
Which is a huge valuation difference.
Yeah, because for every $1, to your point, you that's equal to 4 to 10 or more, right, dollars in valuation terms.
Right.
And it's, again, I mean, it's really just how you're making those measurements.
Right. And so the reason I look at it this way is that over the years I've done a lot of work for GE that's kind of has a new configuration now and CIT Commercial Finance, but they often financed turnarounds for investors or for other companies. And so a good example is the corrugated box manufacturing business, right? For a while it got in trouble because cost of pulp went up. And so if you weren't running optimally and efficiently, profitability dissipated. So, but if you're buying the business and now you're trying to justify to an investor group or to a bank that it's a turnaround. Yeah, it was losing money before, but now we fixed it, right?
Yes.
So then the question is, what did you fix? How did you fix it? How do we track it? How did you effectuate all this, right? And so a lot of what we would spend time doing is building a financial bridge, which is here's the 10 things that they're doing differently. Here's the financial impact of each of those. Here's the timing to expect those, right? Q1, Q2, and here's the activities and costs associated with that so that you could really support that new EBITDA value, right, to help support the financing for it.
Correct, because in a due diligence process, an investor can look at those numbers and say, well, gosh, they were at sometimes at a loss, and now they're positive by $7 million. In the narrative that you attach to those numbers is crucial to the process. Otherwise, that jumps appears to be, at least on paper, right? Because it's one dimension there, but that narrative brings in that second dimension that helps investors identify with, okay, this is the story, this is what happened, and to your point, these are the 10 things that were happening, this is what we changed, and now this is the results of those changes. And so going forward, the perception of continuity is there, which minimizes the perception of risk from the investor, which helps improve the valuation and the deal terms, right?
So just to give you one crazy story, there was a $400 million grocery chain up in Northern California, a Hispanic grocery chain. And he ran a fabulous business, but the one thing he did wrong, and it was kind of when they anticipated kind of converting a lot of folks that were undocumented to documented, and it was in a community where it was a sanctuary city, right?
Yes.
But out of 3,600 employees, 3,100 were undocumented.
Wow.
And so unfortunately, we had to lay off 3,100 employees and replace them in a 6-month period and reset the business, right? So how do you
How do you do that?
No.
Yeah.
Without
damaging
breaking
the
it,
business.
right.
Yeah, without breaking it.
Yeah. So we go through this process and we have to demonstrate that we're training people, bringing them in, bringing in experienced people. But then how do you build the bridge from the way the company used to be run and was very profitable to where you think it's going to be now going forward, right? And it's the same thing. We work through the detail. And in other situations, that entrepreneur may have ended up with nothing. But we were able to basically, in restructuring the business and recapitalizing it, he was still able to retain 50% of the business ownership, right? Yeah. Brought in a new financial partner, and they understood what we had done. They were distressed investors of sorts, but they recognized that, okay, this does make sense, and we'll let him basically drive it the way he did before.
Correct.
Right? So you never know what's going to happen. Right,
yeah.
in a business, and what we've seen recently is two things. One is the price of steel popped up, and it popped up about 4 years ago, I think, as you recall, and it really impacted. There was a rebar fabrication business that was very large in Northern California, and it really hit them. It caught them by surprise. They got caught short, and they were having to buy. They had long contracts and short pricing on steel, and so they're having to pay more than they really ever expected. Yeah. The same thing happened with the paper pulp industry, and so people that were making paper products, that pulp that was coming from overseas, suddenly it spiked, and they were impacted by it. And most recently, the steel prices have gone up, and it's impacted a lot of auto parts manufacturers. We just worked on one recently. And what happens is that price of the raw commodity goes up. They're slow to raise their prices. And when they do raise prices, they don't get the full effect of what they thought they were going to get from the price increases, right? And so I think it's Warren Buffett that often says, when the water recedes, then you find out who's naked, right? So it's when you have that significant change. It may have nothing to do with how you've run the business and have run a good business, but something changes, from an economic standpoint.
Correct.
Right? And you may not have control over it. It's a one-time thing, and that's where we've been able to really help a lot of entrepreneurs is being able to explain that, being able to make the adjustments for it, and not only performing at where they were before, but performing better than they were before.
Correct.
Because for a lot of family-owned businesses, and I see this pretty regularly, is that, let's say it's just for a round number, $100 million business.
Okay.
And they're running at, somewhere between 7 and 10% EBITDA. And that's fine for them because it generates nice cash for the family, everything's fine, you don't have to fight too many battles. But now if something happens, and that's frequently we get called in by the lender, hey, help these guys because they're a good company, good people, but they need to be able to show how and demonstrate how they're going to get back to profitability and be able to service the debt. And so that happens on a pretty regular basis where there's a surprise of that kind, and then we go in there and we sit down with them. It's the same discussion we just had before about the multiplier effect, right?
Yes.
Because if you're going to try and create legacy value for your family, don't think in terms of 10% EBITDA. If your peers in the industry are somewhere between 15 and 20%, think in terms of that. And how do you get there, right?
Yeah, because on a peer-to-peer basis, that's, the market's going to study that. They're going to know that. And if you're below your peers, the perception is that something is wrong in that business.
Right.
And at times that something wrong or multiple things wrong with that business can be the opportunity, but it's who's going to take that opportunity. If they work with somebody like you up front, then that opportunity is for them to increase their valuation.
Yep.
Where if they weren't prepared, an investor will come in and make those changes and ultimately impact that valuation in a positive way, but who wins in that situation?
Right.
So this is the nugget of information that entrepreneurs need to pay attention to, because if they are not thinking this way, if they're not hiring firms like yourself to prepare their companies for some sort of capital event, then at that point, they're leaving money on the table is how I like to illustrate it.
Yeah, I think the term that we use is reverse diligence. So we're basically coming in and helping the company prepare for a diligence. And it's hard for people to justify that sometimes because it's kind of, I got to pay for you to come in and help me prepare for diligence so I can have to pay somebody else to come in and do diligence, right? And when it's a distress situation, I almost have no choice because we're having to go in there and help explain the story.
Yes.
We become part of sitting with management shoulder to shoulder and saying, look, here's what happened to the business. Here's what they've done to fix the business, and here's how they're going to get to profitability and to these targets, right? Yeah. Because it's hard for them sometimes to kind of, they're willing to do it, but it's hard for them to articulate that story.
Correct.
The other thing that we find is that if I walk into a business, and if it's a corporatized business, let's say, and you've got an owner and investors, I can walk through and I can figure out, okay, here's a lot of things that aren't working, right? Lack of efficiencies in the process flow, too much labor. The reporting isn't up to snuff in terms of being able to evaluate your operations, right? And I've done this in the food industry and some others where I can go through and identify a lot of fixes that would help drive profitability. If I do that in a family-owned business, I've just offended half the family, right? I offended the accountant that's in the family. I've offended the guy who's doing floor production. I've offended the guy who's doing distribution, right?
Yes.
And so it's a very different approach with a family-owned business than it is with a kind of an investor-owned corporate type business.
Yeah, absolutely. I see it, and we see it ourselves, right? Where you go into these businesses and they've been run a certain way. I think the word that comes to mind is content. These families grow content with the profitability of the business, the performance of the company. But there are times where there's internal and external impactors of the business. In the scenarios and case studies you shared, there was pulp, there was metal, or steel specifically, right? There's always these forces that are, to the comment that you made earlier. It's when the water recedes, that's when, Warren Buffett said, this is when, people who are naked are exposed, right? And so, but the key to these case studies that you're sharing, there's hope. And the nugget of information is that there is a fix. So if a business is in the situation where, in the interim it's distress, but you could come in, you can make those appropriate measurements, and you can right size if your commodity is steel, and you're buying that steel on a spot market, you're very vulnerable to your margins shrinking in that. And on the flip side, they could have the opportunity to have higher margins, but then you're running a business that you just can't predict.
Right.
So, I would imagine you would go into a company like that and you would say, okay, well, let's work with your vendors. Let's get, let's buy on futures, or let's get fixed pricing and our contract pricing for a period of time, so that then they in turn can go to their customers and say, okay, here's our pricing for the next 3 months or 6 months or whatever duration that is. And then they can predict their business better than they were before. And they would not discover this or learn this unless they had someone like yourself come in to help identify those points and then make those tweaks and changes.
Yeah, and the key is to do it before the commodity spikes, because when when steel spiked recently, it was very hard to even buy steel, right? And it was very hard to negotiate pricing for steel and or delivery for steel. But there's times when the pricing's off on steel. That's the time to go out and negotiate a contract.
That's right.
For longer term value.
Yeah, we too were working on a food and beverage project a couple of years ago, and at that time in the supply chain, there was bottles but no caps, right? Yeah. So you can't sell your product without the cap. You could have all the bottles in the world, which they had a 2-year supply of bottles, but no caps. So what they ended up having to do is go buy new bottles that had caps that fit to solve their problem. But to your point, if you're solving that problem after that shift has been made, you're in trouble. Your margins are in trouble, and let's hope that the business can survive that experience. But sometimes they don't. But or they have to come to a situation where they're making decisions that they don't want to be making, right? Especially when there's family in the business and there's cuts to be made. Yep. That's not an easy conversation, and I could see exactly how you don't make friends with all the family members, when you're coming in and you're making these tweaks, because it's really providing them accountability or accountability tools to go in there and tweak and improve the business. So yeah, that's probably a whole episode in itself, right? The culture of the organization and how people react to changes like this.
There's a lot of stories, but one of the other things I think it's important to highlight is working capital. That's where I see a lot of people getting surprised at the end. There's the transactions closing. Yeah. Now it's kind of like, well, you know what? There's some seasonality to this. Yeah. There's if we're going to grow, it's going to take more working capital. And frequently entrepreneurs don't think in those terms, right? Correct. And that's an important consideration. That's really why, like when we're asked to go in and do diligence, we're asked to look at period to period to period, and month by month by month, not year to year, and to go back 3 or 4 years. And in doing that, then you can really see the seasonality of what's going on. You can see what happens in a December to February time period. You can see that maybe during the summer rush, there's a buildup of cost and capital and inventory and that sort of thing. But it's also an opportunity in that a lot of businesses are run fat, so to speak, right? And the thinking is, I'll just keep more inventory. I'll keep more raw materials because it's a safety net. But what you're doing, though, is that you're tying up working capital you don't need to, right? And that's an opportunity as well, is to make improvements on that. The reason, and I bring this up because it's so important that people just don't get it sometimes, is looking at very detailed financials, not the summary level, but the line item by line item detail, at a trial balance level, right? And not only looking at it from on the financial side, but also the operating side. Doesn't necessarily mean that you're a manufacturer. It could be a distribution business or a lot of other issues. But what drives the operating elements, right? And looking at that, and the simple answer, and when I do a kind of a triage approach on companies, I'm going back and looking at the historical. I look at when the company's most profitable. That's just the simple triage way to say, here's what the ratios kind of should be to get back to that profitability. Longer term, I want to be able to look at every revenue line item, every expense line item, and strategically look at those costs and what they should be, right? But in the short term, if you look at when the company's most profitable, it usually happens because you're pushing through as much volume as possible, but you didn't have the opportunity to build the cost up yet. Correct. Right? And you know that, so maybe it's a little bit too optimal sometimes, but at least it gives you some sense of targets of where you should be. The other thing I think people miss on financials is that when things are going fine, you don't worry about them. But when they're not, you need something to give you a heads up. And so looking at revenue per employee, looking at labor costs per unit built, and even if you're preparing and manufacturing a diverse set of products, at least it gives you an average, and you can see that my labor costs are going up, and I'm not sure why. And one of the things on the labor side that's happened recently, and people really haven't focused on it as much as they should, is that, wow, it's hard to get employees, number one. So I don't want to offend them.
Correct.
Number two is I'm going to use more temp labor because it gives me more flexibility, right?
Yeah. But
And then,
at greater cost, right?
at greater cost.
Yeah.
But what happens, those temporary employees begin to get treated like permanent employees. And then the other thing I've seen recently that needed to get fixed, and they didn't realize how much of a problem it was, well, we're going to tell the employees we're going to give them 50 hours a week. And then what happens is 50 hours a week becomes standard, but the production levels shift on you, right?
Yeah.
So production comes down, but they're still expecting to get 50 hours a week.
Yeah.
And the good news is these are employees that want to work the time and,
Yes.
and be there.
Yeah.
The bad
You just have
news
to give
is
them the work.
you got to adjust your volumes, right?
Yeah.
And so, when times are good, you don't worry about it as much. When times are a little bit tougher and there's flux in the economy, you really have to look at the production planning elements, right?
Yeah.
And what I've noticed with a lot of companies too is that as they grow and closely held businesses frequently don't focus on kind of that cost accounting element, and that they can get caught with a lot of surprises as they grow. Pricing shifts, customer buying patterns shift, and they didn't realize it, and suddenly all the cheaper products with low margin are being sold, and the good stuff is, got shifted out, right? And the other thing I've seen too is that when companies get in trouble, what's the first thing they cut? Administrative costs. They start cutting accountants. They cut out the cost accountant. Now they're going blind, right?
Correct.
And that's the biggest issue I find with companies is that looking at the gross margin. The cost structure, I can compare that against historical and say, okay, it's gone too high and we can fix that quickly. What's hard for people to understand frequently is the gross margin analysis. And what are the pieces of it, and how do you go about fixing that gross margin, right?
Yeah.
And that's where you really have to look at all the financial elements and your operating costs and the operating detail and operating statistics to be able to figure that out.
George, thank you for coming in and spending time with us here today, talking through these case studies and the stories. I'd love to have you on in the future, and there's so much more we could talk about. We could probably sit here for hours and hours and talk about different case studies and experiences that we've had.
Yep.
But thank you for being here, George.
No, that's terrific. Thanks,
Yeah,
Brian.
thank you.
And one of the things I want to be able to say about you and your firm is that you're unusual from an investment banker standpoint. You're actually trying to help the company. You advise them. You spend a lot of time that wouldn't normally, most investment bankers wouldn't do. And that's the thing I find very important, is because most people are very transactional in your world. To actually have somebody that's thinking through how do you help them drive their value is very different.
And that's the whole purpose of this podcast, is really to educate folks and provoke thought in them so that they can make those moves, right? Otherwise, if they're sitting there, not knowing what to do when it comes to that time that they have to exit, there's not much that can be done at that point in time, or there won't be at least enough runway to correct everything.
Right, absolutely.
So thank you again for being here, and thank you for joining another episode of Private Capital Mastery. I'm Brian Franco, your host. I'm looking forward to seeing you next week as we unpack more and more details about the private capital markets. If you have any questions at all or would like to be put in touch with George, feel free to email us at info@meritage-partners.com, and we'll be happy to connect the dots. Until then, have a great week, and we'll see you soon.